me play devil's advocate. So very
Yeah.
obviously very short, but very deep. If you look at the depth to which we saw the fall off in growth and productivity and in a series of economic markers for the real economy, I mean, it was dramatic. It's a straight line down.
Oh yeah, it's the biggest recession pretty much in all recorded history. But it's 2 months.
So how do you square that if it's the shortest and the deepest?
It's because, and I strongly think it's the debasement of the denominator of the value of fiat currency overall is hiding what has actually happened here. And that is the magnitude of the economic shock of what happened and happened in 2008 and happened in Europe in 2012 is real. And ask the average guy in the street, right? It's not what the equity price is showing. And that's the disconnect. And people think it's because rich people are buying more equities and all of it. It's not. It's because stealthily, or actually not very stealthily, but without making it clear to the average person, they've lowered the purchasing power of the currency, which allows you to buy less assets with your dollar. It's as simple as that. So it looks like the prices are going up, but the actual purchasing power is going down.
Yeah, and if you'd like a chart, I know we can't show it live here, but look at the M2 money stock chart, WM2NS on the Fed-Fred database. Watch that rate of change, the acceleration coming out of the 2020 recession.
No, we've only grown it by 30%, Ash. I mean, only 30%, right? I mean, this is my point, right? I mean, we just had the worst recession in history, to Ralph's point. It lasted 2 months. And we are still responding as if the world is about to end. And so, to my mind, it's utterly irresponsible. And we're not backing away, we're doubling down.
Julian, what happens if, and I don't believe it's irresponsible, actually. I think the actual economy is more broken than people understand. I think the amount of debt, the pension liabilities, the disruption of technology on the jobs market, I think is larger than many of us understand, which is the reason why the Federal Reserve can't raise rates. So let's say you're right? Let's say inflation stays elevated and the Fed raise rates. I mean, you're just going to destroy everything.
Yeah, again, mate. I mean, as I said, remember, they started in 2014 to try and tighten, right? Do you remember in 2015 when the Chinese devalued, right? They went off to Davos. All the central bank governors did the international sign of distress, and Janet Yellen reversed policy, right? So then you fast forward another year, and they start to tighten again, right? And then we go into the end of 2018. They've been hiking, tightening, whatever, right? And then the world falls apart again, and they reverse again. They're snookered, Raoul. So they can't ever tighten policy. They can try, and we can take advantage of that. But that's it. They're snookered. Until one day the end game comes and someone calls their bluff on this maybe continuous money printing.
And by the way, the counterpoint to the M2 stock expanding is the velocity of the M2 money stock collapsing from 2020.
But Ash, just take the Fed's balance sheet and take velocity and put them on the same chart, and you'll see they're just purely inverse. So the reason in part the velocity's been dropping so fast is the denominator of the velocity is the quantity of money, right? So as you print more money, by definition, that denominator rises in value and that velocity falls. So it's a bit kind of deceptive. Don't get me wrong, the velocity has definitely slowed. It takes more and more money to create X amount of GDP.
Yeah.
But it isn't quite as dire as the straight velocity picture would let on.
And this is the debate Julian and I have been having for several months now. I keep asking Julian, okay, so we can't have a recession. Assets are not allowed to go down. And you keep telling me you're worried about inflation. I'm like, well, why do we care? Assets are not allowed to go down. We're not allowed a recession.
Yeah, but you can get, the point is, I think this is what I would say. You still have a Fed, you still have a bunch of central banks. Maybe they're becoming less convinced over time. Like the markets learn that the balance sheet and equity markets are the same bloody thing, right? So, but if you push central bankers hard, on their own, and I've done it, and I had one admit to me, right, that this is the problem that they face, but they still kind of want to believe that somehow they can escape, a jail, and they don't have to go straight to jail. Like they can go past go, right, and collect their $200, right? So they keep wanting to kind of normalize the economy. So they sort of talk about this little process, and they follow their merry little dances. And they say, we're going to start tapering. And you go, okay, I know how that was going to end up, mate. Just bring it to me, Daddy. Bring it to me. So our role is to watch for when things get too hot, and they try and taper and tighten. And then to Ralph's point, we just go, cheers, mate. Thanks. I'll buy a bunch of risk, right? And ride it again. Because there's nothing they can do, Ash. If you look at the correlation between total employment in the US and the equity market, it's the same chart. So in other words, the equity market drops, employment drops, right? The equity market goes sideways even, employment levels off. So that means you get zero non-farm payroll every month, by the way, right? Zero, right? You imagine what the Fed would be doing at zero. They'd be going like, oh my God. Oh, so what do you have to do? You have to keep the equity market going up all the bloody time. All the time.
And the only way of doing that is devaluing the money.
Chung, 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 right?
Well, gentlemen, the one thing we have learned for sure is that we clearly need to do this again and more frequently. This was a great conversation. And while I hope the world is not about to end, unfortunately, this show is. Let's just get your final thoughts, Julian, on where you see this going until we can meet again.
So I think, Ash, to Raoul's point, we're probably in this period of sort of softening data because these accelerations just can't keep going forever, right? I do think there's more upside coming on the inflation print. I think we're probably going to hit CPI, at least hit 7, maybe even above, okay? And in Europe a lot more. But then naturally, mathematically, the speed falls off and then people will get a little bit excited. I think the Fed is going to be challenged again, probably in the autumn, by some of these inflation metrics and by some of these growth metrics. And I think that's when you look potentially for risks to sell off, and then you just hold your nose, close your eyes, buy the dip, because that's what you do every single time.
Raoul, final thoughts.
I'm kind of more in the David Rosenberg camp. I think it slows down more than expected. If it does, the equity market sells off, the Fed come back, the markets go up. The point being is it's irrelevant which action, what outcome, they're all the same outcome. So I think bond yields go lower. If bond yields go lower, then tech stocks go higher. There is no stopping this. So I am more cautious on the economy. And if that is the case, then you could see a sell-off in stocks. Again, it won't last. So, I mean, that's it. That's the entire game now. There is no other instrument because the Fed don't want the bond market to move either way, really.
They can't allow the equity market to go down.
No. Now, the currency market, I personally don't think it's going to move either. I think the dollar gets a bit stronger for a while, but it's within a broad range. And it has to be proven. Julian's more bearish the dollar, I'm slightly more bullish. But in the end, if it stays in that range, then we have no macro variables. No credit, no currency, no bond market. You're left with one single instrument to pile all the money into, and that is the equity market.
No risk in that then, ultimately, long term.
But there isn't.
Well, no, there can't be. But your point, it can happen on a relative basis, and the reason why I'm very much in the sort of Druckenmiller, Grundlack, that ultimately the end game is that the dollar is that you receive your dollars in a big roll. They're white with perforations between them, and that's where ultimately the value of the dollar is going. But we haven't got there yet, mate.
No,
you're going to have to get the pain
for another year.
The pain first. Get them to come in and print more money yet again. Spend more money on fiscal. Right? I think that's where we're going.
I'm glad this is a Friday afternoon because I need a strong belt after this one.